Welcome to this Pangea Risk webinar. East Africa remains one of the fastest growing economic regions on the continent, but the nature of that growth is changing. The Gulf War, ongoing since late February, has tested the region's resilience to external shocks in ways that were largely theoretical until now. Today, I'm joined by Gabrielle Reid, our head of advisory, to unpack what that means for trade, for infrastructure, and investments across East Africa. Gabrielle, let's get straight into it. I have a question. The Gulf War has been running for over 2 months now. Have the economic concerns for East Africa actually materialized? Or has the region proven more resilient than expected?
Thank you, Robert. I think the concerns have certainly started to materialize, and in some cases faster than anticipated. Perhaps one of the clearest examples is Kenya. If we just look recently, the central bank held its lending rate at 8.75% in April, and this ended 10 consecutive rate cuts. The central bank explicitly cited Gulf War disruption as the reason for this. At the same time, the bank's growth forecasts were trimmed, and it confirmed that foreign exchange rates fell from around $14.4 billion US back in March down to $13.24 billion in late April. Now, the primary risk transmission channels of the Gulf War for East Africa certainly remains fuel prices, fertilizer costs, and freight costs. Now, when we look at Kenya, Kenya imported 26% of its fertilizers from the Persian Gulf in 2024, ranking fourth on the continent in terms of fertilizer imports from the region. Those same shipments are now arriving late, arriving at a higher cost, or not arriving at all. At the same time, an estimated 70% of consumed petroleum products across sub-Saharan Africa are also imported, with strategic reserves across the continent far below International Energy Agency's 90-day benchmark. And that is going to place additional pressure on fuel importers across the continent. Now, in Kenya's case, this economic shock has been compounded by a governance issue. In March, a 60,000 metric ton fuel consignment arrived at Mombasa, procured outside established government-to-government agreements, and priced approximately 40% above the agreed benchmark. The incident triggered the resignation of several senior energy officials. Now, episodes of this nature have a disproportionate impact given the current environment. They undermine policy credibility at a point where holding on to investor confidence and institutional trust will be critical. Now, Kenya's resilience remains intact in several respects, but it's certainly being tested under significantly more demanding conditions.
Absolutely. And I've got a follow-up question to that, Gabrielle. East Africa's infrastructure development is often cited as a structural driver of long-term growth. For you, what are the most significant developments underway, and what do they mean for trade finance demand?
I think the infrastructure story is genuinely significant. For East Africa specifically, the Northern Corridor, which will link Mombasa through to Kampala and beyond, or even the Central Corridor from Dar es Salaam into Rwanda and into Eastern DRC, are routes through which intra-regional trade will flow. So improvements to port efficiency, border management, and road quality along these corridors are already creating new bankable transaction flows for agricultural produce, light manufactured goods, or even food processing outputs and the likes. So the demand for trade finance to support these flows is certainly growing. Now, the primary underserved segment is certainly SMEs or emerging exporters, with businesses needing to adapt to new trade partners, and perhaps trade partners that lack collateral and financial documentation that traditional gatekeeping requires in the trade financing space. So closing that gap is both a commercial opportunity and, of course, a structural challenge as well. I would say that the African Continental Free Trade Agreement will certainly provide the framework for enabling such trade finance. Infrastructure investments will be the physical enabler. The question is really around whether the financing ecosystem can scale to meet this clearly growing demand.
Final question, Gabrielle. Where do you see the genuine growth opportunities for trade and investment in East Africa over the next few years? And are there any countries that stand out as particularly well positioned?
I think the structural growth drivers across East Africa are certainly intact despite these near-term headwinds that we're exploring. We look at urbanization as accelerating, the working age population is certainly expanding, and we are seeing a shift from raw commodity exports towards regional value chains. As I already mentioned, this is in agribusiness, food processing, and light manufacturing. And this is creating demand for trade finance solutions that are perhaps better suited to these commodities and better suited to the next decade rather than the last. Now, in terms of markets, certainly as one of the largest economies in the region, Kenya remains the most commercially sophisticated market and the most integrated into global trade networks. Now, despite the current pressures that we've obviously discussed today, it has the deepest financial sector, it has among the strongest logistics connectivity and the most developed digital trade ecosystems. At the same time, if we look at tourism receipts, for example, which grew to around $3.8 billion in 2025, with just under 8 million visitors that year, is certainly showing a meaningful non-commodity based revenue stream that supports external buffers. I would also mention Tanzania is certainly an increasingly important story in East Africa, particularly given its role in that central corridor and the role in connecting landlocked markets to the Indian Ocean ports. Of course, political risk following the contested 2025 election does bear watching, but the infrastructure investment strategy and trajectory and growing commercial base in Dar es Salaam are certainly positive signals.
Thank you, Gabrielle. So if I've understood correctly, East Africa's growth story is not derailed in the long term by the Gulf War, but it is being stress tested in ways that reveal which economies have the buffers, the institutions, and the governance quality to absorb external shocks, and which do not. And that divergence is exactly what we at Pangea Risk in our analysis is designed to map. In fact, Gabrielle, I believe you'll be in Nairobi next week meeting with a number of our clients, and we look forward to hearing more insights from in-country in due course. Now, for more detail on any of the countries or themes we have discussed today, visit pangea-risk.com or contact us directly. Thank you, Gabrielle, and thank you for joining us.